Stop right there, because what I'm about to lay out could decide whether 2000 XRP becomes a ticket to freedom or a souvenir from the moment institutions slam the door shut. Give me the next 60 seconds and I'll show you why the window that looks wide open today can snap closed without warning. At the time of recording, XRP is trading around 278s. For context, XRP is around that level right now. If you're watching this later, the price may have shifted. None of this is financial advice. Always do your own research and talk to a professional before making decisions. Here's the setup the majority are missing. Global finance is creaking under the weight of a decade of engineered liquidity. Carry trades built on cheap yen, yield differentials pumped by policy, and a bond market that has quietly become the center of gravity for everything from mortgages to corporate credit. If you've heard the term reverse carry trade, you already know the outline. Money borrowed in low-rate currencies pours into higher-yield assets. But when volatility spikes or policy pivots, those flows can whip back in a hurry. That's not just a headline. It's a chain reaction across currencies, bonds, and equities. And it's the exact type of storm that exposes which assets are toys and which are tools. Now layer in Japan. Years of ultra-low rates turned the yen into the world's favorite funding currency. When risk rises or the policy stance changes, the unwind isn't a tidy line. It's a stampede for exits. Investors sell what they can, not what they want, and they rush through FX markets to rebuy yen and square books. That pressure hits treasuries, eurobonds, stocks, even commodities through forced selling. And when everyone reaches for the same liquidity at once, the system shows you where it's brittle. Stay with me here, because in about a minute, I'll explain how that brittleness sets the stage for XRP's role. The bond market is the plumbing of modern finance. Governments refinance at scale through it. Banks price loans off it. Derivatives reference it. When yields spike, the price of safety can actually become the epicenter of risk. We saw glimpses of this in past stress events. Liquidity dries up, spreads blow out, and market makers widen quotes or step aside. That's the shallow lake reality. Everything looks deep until the drought hits. If you hold on for just 60 more seconds, I'll connect that directly to why the number of XRP you own matters more than its price in the short term. In that kind of environment, settlement speed and neutral rails aren't a luxury. They're oxygen. The legacy model of correspondent banking, pre-funded accounts, daylight exposure, and batch settlements struggles when volatility and cross-border demand surge simultaneously. You don't need a conspiracy to see it. You only need to watch how quickly FX spreads widen when fear rises. The world needs a bridge asset that can source liquidity on demand, net positions in seconds, and reduce the need for trapped capital. This is where XRP's design becomes relevant, not as a meme narrative, but as infrastructure. Let's be clear about what bridge means. It's not a buzzword for speculation. It's the function of moving value between siloed pools without waiting on slow rails or locking up cash. When markets are calm, almost anything works. When markets are stressed, only systems built for throughput and finality survive the crush. XRP's pitch has always been simple. Settle fast, settle final, settle without pre-funding. If global volatility forces capital to move faster and more often, the entities that have quietly prepared corridors and liquidity programs won't be improvising. They'll be executing. Now you'll hear skeptics say, if that's true, why isn't the price already in double digits? Good question. And the answer is where people get blindsided. Markets don't usually pay you for noticing what's obvious. They pay you for understanding what's coming while the surface looks boring. Liquidity builds quietly, corridors are tested quietly, and inventory gets positioned quietly. The public moment, the repricing, is the last chapter, not the first. Don't click away yet. In the next minute, I'll unpack how that repricing can happen in leaps, not steps. Think about order books on exchanges as a glossy lake surface. There's depth posted, numbers flickering, trades crossing. But the water level, the true float available at size, has been receding for years as tokens drift into custody, long-term storage, or institutional arrangements that don't recycle back to retail venues. When a large, price-insensitive buyer enters, the book doesn't have to be empty to move violently. It just has to be thin where it counts. That's how gaps form. One moment fills at 3.6x, the next, the book is cleared to the mid-4s before new offers appear. If you've ever watched a short squeeze, you know the feeling. The market doesn't rise so much as it teleports. Now add one more accelerant. The institutional habit of building floors. When a big player commits to using an asset for settlement or liquidity management, they don't try to snipe bottoms day trading style. They absorb on weakness, they hedge professionally, and they size for the role, not for the meme. Over time, that behavior compresses volatility on the downside and relocates it to the upside. You'll still see violent moves, but they skew toward repricing events rather than collapses because there's a standing bid informed by utility. Give me one more minute and I'll show you how priced out happens while the crowd waits for a perfect entry that never arrives. Priced out isn't just about an absolute number, it's about accessibility. At $2, $3, many viewers can still assemble a four-figure stack. At double digits, fewer can. At sustained double digits with thinner dips, most can't. But the supply dynamics don't care about comfort, they care about function. If adoption escalates, there is no mandate that says the market must pause at wallet-friendly levels. That's why the number of units you hold before the system needs them can matter more than your average cost by a few cents. The crowd fixates on price, professionals fixate on float. This brings us back to the macro trigger. A disorderly unwind of carry trades or a sharp policy pivot isn't required to validate XRP's use case. It only accelerates the timeline. When capital sloshes globally and time to settlement becomes a bottleneck, rails that clear in seconds are not just faster, they are safer in operational terms. In a world recalibrating around tokenized collateral, on-chain treasuries, and always-on payments, a neutral bridge with proven finality becomes the connective tissue. And connective tissue tends to be invisible until it isn't. You might be thinking, okay, but how does this translate into my bag today? Here's the straight answer. The crucial decisions happen before the chart makes them look obvious. That doesn't mean rushing or overexposing yourself. It means defining your threshold now. If you believe the next phase is a repricing toward utility rather than another hype cycle, you prepare accordingly. If you're unsure, you keep learning. But understand that the market won't schedule a courtesy countdown. When the lake drains, it reveals who positioned and who procrastinated. Stay with me, because in the next section I'll break down, step by step, how a liquidity shock actually moves through bonds, FX, and equities, and how those mechanics create the exact conditions where a bridge asset can buffer the chaos rather than be swallowed by it. Give me 60 more seconds next time and I'll map the flow from forced selling to FX conversion to settlement and show you where XRP fits when order and disorder collide. XRP is consolidating in the low single-digit dollar zone. For context, it's hovering in that area right now. If you're watching this later, the price may have shifted. When a carry trade starts to unwind, the first motion is subtle. Funds that borrowed in a low-rate currency sense risk ticking higher, so they trim exposure in the most liquid assets they can sell quickly. That liquidity is usually found in sovereign bonds and index futures, not the fringe corners of the market. As positions de-risk, selling pushes bond prices down and yields up, which tightens financial conditions for everyone at once. Traders aren't thinking about narratives in this moment. They're thinking about balance sheets, margin calls, and what can be converted to cash without slippage. The unwind then migrates from bonds into equities, where futures markets absorb the initial hit and dealers hedge inventory by shorting broad indices. This isn't panic yet, it's calculus. But calculus turns into chaos when everyone runs the same play simultaneously. The next motion travels through foreign exchange. Proceeds from asset sales in dollars or euros must be converted back into the funding currency to close the loop. In recent history, that funding currency has often been the yen. When demand for the funding currency surges, it strengthens abruptly, sometimes in a straight line. That strength compounds the problem. Assets marked in dollars are now worth fewer yen on conversion, so managers sell more to reach the same repayment target. The feedback loop tightens, and liquidity that looked abundant suddenly feels rationed. Market makers widen spreads, risk limits bite, and you can almost hear the machinery creak. This is the environment that exposes the cost of waiting 2 days for settlement or tying up capital in pre-funded accounts just to guarantee transfers will arrive. If your cash must be in the right place at the right moment and your existing rails move at the speed of paperwork, you pay in either time or spread. Neither is acceptable when the clock is your enemy. That's where neutral liquidity bridges matter. They can net multilateral flows in seconds, reduce trapped capital, and keep assets moving without asking every participant to maintain piecemeal pools around the globe. Now think about what makes a bridge effective under stress. First is finality. When books are shifting rapidly, you need to know a transfer is done, not pending. Second is speed. Netting risk and redeploying collateral in minutes instead of days is the difference between forced selling and optionality. Third is neutrality. If the bridge is not itself a sovereign currency or a counterparty that relies on credit, it can root value without inheriting the policy baggage of any single nation. This is the theoretical niche XRP was engineered to fill, long before the current macro jitters made it obvious why. In Japan, the strategic question isn't whether to participate in the future of digital settlement. It's how to do it without amplifying volatility. Large incumbents have spent years piloting new rails. You'll see references to payment corridors, pilot CBDC programs, and private sector exchanges standing up licensed fiat on-ramps and off-ramps. The aim of all that plumbing is simple: transform cross-border payments from a pre-funded chore into an on-demand process. In that architecture, a fast final settlement bridge becomes the gasket that keeps the engine from seizing when pressure spikes. Imagine a day of heavy stress. A European asset manager sells dollar assets, needs yen, and needs it now. In the legacy path, they sell, wait for settlement, push through congested FX markets, and pray their counterparties don't widen spreads mid-transfer. In a modern path, flows can be netted via a bridge, converting dollar liquidity into yen exposure in seconds, then freeing the funds at the destination. The bridge does not eliminate risk. It compresses the time window during which risk can metastasize into a spiral. When hundreds of institutions act at once, shaving hours off each cycle is the quiet difference between order and disorder. Don't miss this next 60 seconds, because this is the single most important mechanical trigger behind institutional repricing. When markets are calm, everyone obsesses over headline price. When markets are stressed, everyone obsesses over available liquidity at size. Those are not the same thing. If a bridge asset can clear large notional transfers with minimal balance sheet friction, its operational demand rises precisely when legacy rails are most clogged. That demand doesn't arrive as retail FOMO candles. It arrives as steady, size-insensitive absorption that conditions the order book to teleport rather than trend. You can watch this happen through the sequence of microstructure shifts. Depth posted at each price level becomes more ephemeral as real. Participants prioritize speed over perfect fills. Maker quotes flicker because professional liquidity providers manage inventory with tighter risk caps. Market orders slice into the book in larger clips, clearing several levels at a time. To the chart watcher, this looks like gaps. To the execution desk, it looks like an urgent need to secure fills before spreads widen again. If you've ever waited for your perfect dip and watched the market run away in a straight line, you felt a tiny version of this effect. Here's where the dynamics around banks, exchanges, and liquidity programs become crucial. If large institutions have prearranged corridors, they can move on-chain value through a neutral asset without warehousing pools everywhere. If central bank pilots prove out always-on settlement windows, the timing mismatch that used to force pre-funding shrinks. If regulated venues maintain compliant on- and off-ramps into the bridge, then operational teams can treat it as a standard pathway rather than an experiment. None of that requires a press release on the day you're watching this. It requires the pipes to be ready before they're needed. All of this feeds back into the personal question haunting every holder. How do you avoid being priced out without chasing green candles? The answer is to think like the flows. Big money plans for constraints, not headlines. If you believe an unwind or policy pivot will stress legacy rails, then you must assume the market will pay a premium for speed, finality, and neutrality at exactly the wrong moment for retail to act. Priced out then becomes a function of scarcity colliding with utility. It isn't about whether price printed a round number, it's about whether the path to meaningful size remained open after the book thinned. Let's also address the objection that a bridge asset could be replaced by a private network or a closed loop among a handful of banks. In quiet times, closed loops work. In stress, closed loops become choke points. If everyone needs the same corridor simultaneously, capacity limits turn into price explosions. Neutral bridges allow pressure to vent across many paths at once. That multiplicity is what keeps individual bottlenecks from breaking, and it's why an asset designed for open settlement can become more, not less valuable when volatility spikes. Stay with me, because the second-order effects matter. If a bridge absorbs flows during stress and institutions like the behavior, they codify it. That codification shows up as standing programs, committed liquidity, and playbooks that make the next stress run smoother. The market then assigns a higher baseline value to the bridge, not because retail sentiment improved, but because corporate treasurers and settlement desks decided the process belongs in standard operating procedure. That's how base prices lift and never fully revisit the old floor. The crowd thinks bull market. The pros think we upgraded the plumbing. You'll also notice that as these processes entrench, volatility changes shape. Downside shocks become sharper but shorter as programmatic bids absorb weakness. Upside moves become more gappy as supply at old levels is thin, and strategic sellers prefer to offload into momentum rather than try to nail tops. The chart starts to look less like a sine wave and more like a staircase with missing steps. If you hold on for just 60 more seconds in the next section, I'll show you how shrinking exchange reserves and custody growth harden that staircase by removing free-floating supply from the levels traders expect to buy. Before we pivot, fix this mental model. An unwind isn't a single event. It's a procession of constraints revealing themselves in real time: funding, settlement, FX conversion, counterparty risk, and regulatory friction. Every constraint rewards tools that minimize time in transit, reduce trapped capital, and finalize quickly. A bridge asset that checks those boxes does not need fanfare to matter. It needs volume, and volume arrives when stress tests legacy rails harder than any marketing campaign ever could. In the next section, we'll go inside the order books and wallets. I'll walk you through how exchange reserves have trended, why ETF and custody structures matter for the visible float, and how the shallow lake analogy turns into real-world price gaps when institutional flows switch on. Don't click away. The key detail that most people miss is just ahead, and it's the hinge between being positioned and being priced out. Liquidity is the invisible fuel that powers every financial system, and right now we are watching the supply of XRP on public exchanges dry up faster than most people realize. Every week, millions of tokens are quietly moving off retail platforms and into cold custody, institutional vaults, and ETF structures designed for long-term holding. This isn't just about speculation anymore, it's about the slow but steady removal of circulating liquidity from the open market. Imagine a shallow lake in the middle of summer. Every day the sun evaporates a little more water, and what once felt endless now looks dangerously thin. That's XRP today. For retail traders checking their apps, it still seems like there's plenty of liquidity, but in reality, the depth is vanishing, and when institutional players step in to scoop up what's left, the market will shift violently. This is why institutions love these environments. Retail holders panic over small dips, selling into fear, while bigger players quietly absorb supply. Once they lock those tokens into custody wallets or ETF products, they're effectively removed from circulation for years, even decades. The retail crowd is left wondering why their buy-the-dip strategy no longer works, because each new floor is higher and the pools of available liquidity get shallower. Here's the critical difference most people miss. In past crypto cycles, liquidity expansion came from hype and new retail entrants piling in. This time, the liquidity contraction is intentional. It's being engineered by institutions who know that controlling supply means controlling price. Every XRP moved into an ETF structure, every token locked away by a bank for settlement pools, is one less token available to trade. That's why the psychology here matters so much. Retail investors are conditioned to chase pumps and panic sell dips. Institutions are conditioned to think in decades, not days. When you're operating at trillion-dollar scales, you don't care about whether XRP ticks up 50 cents this week or down $1 next week. You care about securing enough of the asset before liquidity is structurally repriced. So let's break down the phases of this revaluation clearly. First comes the liquidity crunch. That's where we are now. Exchanges shrinking, ETFs absorbing, institutions quietly building. Second comes utility scaling. This is when the corridors go fully live. Treasuries, bonds, and tokenized assets begin moving daily across the XRP ledger, and the demand for liquidity outpaces the supply sitting on exchanges. Finally, the last phase is institutional dominance. That's when retail no longer sets the tone of the market because the floors are owned by entities with billions at play. And here's the kicker. We are rapidly moving from phase 1 into phase 2. You can already see the signs. Tokenized treasuries aren't theory. They're live. Ripple's RLUSD isn't a concept, it's issued. Custody giants like Standard Custody and Mitaco are locking up supply for clients who think in terms of infrastructure, not short-term flips.
This is why the analogy of a shallow lake is so important. Once the water level drops low enough, every small wave creates massive ripples. That's the environment XRP is about to enter. Small injections of institutional liquidity can trigger outsized moves, because the float is that thin. Retail traders will see spikes they can't explain, thinking it's just another pump and dump. But in reality, those are the signatures of structural revaluation. Now don't miss this next point, because it's the single most important trigger behind the transition. When ETFs and custody providers finish absorbing a critical threshold of XRP supply, Retail exchanges will no longer dictate the price. Instead, price discovery will happen at the institutional level, behind closed doors, where settlement needs force valuations far higher than retail ever imagined. This is when the narrative of cheap XRP ends permanently. Think about it this way. If you were one of the few holding significant XRP bags during the liquidity crunch phase, you're sitting on an asset that institutions can't function without. That leverage doesn't exist in meme coins or even in Bitcoin, which lacks the settlement design XRP has. It only exists here, in this narrow window where supply is vanishing and utility demand is set to explode. Before we move forward, remember this. Scarcity is not just about supply, it's about who controls it. And very soon, the answer will no longer be retail traders with a few thousand tokens. It will be banks, ETFs, and global institutions sitting on massive locked positions. Once that shift happens, the revaluation isn't optional. It's necessary. When people talk about crypto, they almost always default to Bitcoin or Ethereum. Bitcoin as digital gold, Ethereum as the smart contract hub. But here's the blunt truth. Neither of them was built to do what XRP is about to do. Bitcoin is too slow, too energy heavy, and too rigid. Ethereum is powerful but expensive and fragmented, relying on endless layer 2s to scale. XRP, by design, is lean, fast, and built for one purpose: to move value at scale across borders, instantly, without friction. That's the difference between speculation and structural revaluation. Now let's zoom out to the macro backdrop. Central banks are cutting rates again, desperate to keep liquidity flowing into a fragile system. Bond markets are wobbling under $10 trillion of carry trade exposure. Equities are at all-time highs, inflated by easy money and government interventions. Historically, moments like this don't end quietly. They end with a reordering of capital and assets designed to catch that capital flow surge to the top. In the dot-com bubble, it was internet infrastructure stocks. In 2008, it was gold and safe havens. In 2025, it's going to be XRP. Why? Because unlike Bitcoin or Ethereum, XRP's valuation is not tied to hype cycles or halvings. It's tied to necessity. You cannot run trillions of dollars of tokenized treasuries, bonds, and cross-border settlements on assets that choke under load. The pipes of the system don't care about ideology, decentralization purity tests, or narratives. They care about throughput, settlement speed, and stability. That's XRP's entire design philosophy. Here's the psychology trap that will leave most people behind. The majority will sell too early. They'll watch XRP climb from $3 to $10, then $20 and think, I just made a huge return. I'm out. They'll convince themselves that taking profits is smart, not realizing they've cashed out right before the structural revaluation phase kicks in. Because in their mind, XRP is still another crypto trade. In reality, it's about to become the backbone of a new monetary system. Meanwhile, the few who hold, the ones who can stomach the noise, will experience something most retail investors never see: being positioned on the right side of a systemic repricing event. It's the difference between those who sold Amazon at $20 in 2001 and those who held it into the 2010s. Between the early internet speculators and the ones who understood the infrastructure was the real play. Think about where this is heading. Banks using XRP daily, not once in a while, but as a standard operating mechanism. ETFs quietly holding billions in locked supply. Ripple corridors moving institutional capital at speeds no SWIFT system can touch. And retail investors looking back, realizing the window to accumulate meaningful positions closed forever once double digits were breached. This is why the calm we're seeing now is so deceptive. The charts look sleepy, the news cycle feels repetitive, but beneath the surface the architecture is snapping into place. Settlement rails, tokenization frameworks, custody arrangements, all the plumbing is being built behind closed doors. And when they flip the switch, XRP doesn't need retail hype to move. The system itself will demand the higher price. So let me leave you with this thought. Every great financial reset in history has a moment when those who see it ahead of time feel almost crazy, like they're shouting into the wind. And then, overnight, the tide turns, and the world acts like it was obvious all along. That's where we are with XRP. Most people dismiss it, some quietly accumulate, and a handful truly understand what's about to happen. Here's the hook you can't ignore. Imagine waking up one morning to see XRP no longer quoted in single digits or even tens. Imagine it repriced in the hundreds. Not because of hype, but because the system itself required it to function. At that point, it won't matter how many tweets, videos, or charts you read. If you weren't positioned, you're simply out. The silence you feel right now isn't safety. It's the pause before the detonation. Like, comment, and subscribe for more content.